Thank you. Thanks. Thank you. That was great. So I'm going to talk to you about a crash course to financial engineering. So financial engineering is where you have a series of data, financial data, and you're trying to draw conclusions from it. You're trying to understand the risk and the rewards better around the series of data. And series of data is just financial data. It's stock data, equity data, ETFs, futures data. So I'm going to show you how to, and I'm going to do a crash course to using a spreadsheet. And even if you're not comfortable with a spreadsheet, we're going to step through it with 4 clicks and 55 characters. We're going to build a spreadsheet so that every time you open the spreadsheet up, it's going to automatically pull in the most recent prices, and then you can start doing and start tooling around with it, creating prototypes with it, and you're going to understand some statistics around that data. So let's get started here. So how many people, just a show of hands, how many people had a position in Apple over the past several years? So a lot of people. And this is one of the most widely held stocks in the world. And there's some reasons for that. One, it's a company that many of us use. I have an iPhone. I use a Mac through work, as most of us at work do. And it's also held within the S&P 500. It's held within the Dow. It's held within the NASDAQ. So many people have it. If they don't own the shares, they own it indirectly through 401k plans, through IRAs. So many people hold this stock within their portfolio. Many people would actually be surprised at how many shares they actually own when they account for it through all that. But it's funny, when the stock went from 230 to 150, when it goes up, everybody loves it. MarketWatch, Yahoo Finance, CNBC, everybody's talking about it, how it's going to continue to go up through the moon. It's going to be the first $10 trillion company. And then when it starts going down, you know, everybody starts turning in the other direction, and they start talking very negative about it. And so then you start believing the news. And of course, in January, would have been the best time to buy it, because then it continued to go back up to almost where it was right beforehand. And it's very easy to say, well, that move came from nowhere. That was completely unexpected. However, and this is what we're going to talk about today, and we're going to look at these stats, and we're going to learn how to calculate these stats within a spreadsheet, step by step, is in January, the July options actually had a 33% volatility, meaning over the course of a year, that stock was expected to move up or down by 33%. And the movement from January to July, which is where we are right now, was about expected a $40 move, $38 move up or down. So that was a pretty large move. Now, it just closed yesterday at 203.30. So actually, it was a little bit outside of that expected 1 standard deviation range, but it was well within the 2 standard deviation range, which is actually just about 2 times that 1 standard deviation move. So it was well within that 95% expected range. And so I'm going to talk to you what that means. And then also, looking more, taking the financial engineering approach and looking closer at this data, you can see that the largest 6-month drop was about 60% over a 6-month period. And the largest 6-month increase was about 105%. So this was well within the expectation of, or you shouldn't have been caught off guard with these particular moves. So financial engineering is about understanding positions in a more holistic way and using statistics around it so you're not caught off guard. And that's what we're going to talk about. So in under 30 minutes, we're going to build a spreadsheet. We're going to go from 4 clicks, 55 characters, to pulling in data so that you can pull up your spreadsheet anywhere, any computer, your phone, your cell phone even, because it's all cloud-based. We're going to use Google Sheets to be able to do this, which is a competitor to Microsoft Excel. And then we're going to understand some different levels of risk around positions, around stocks. And the cost to you, if you don't place any value to your time, it's going to be 0, right? If you place a little bit more value to your time, it's going to be whatever your time is costing for this 30-minute talk. But And then this is a little screenshot of the spreadsheet that we're going to be looking at. So what you can see here is you can see that we have the data, we have some statistics around it, and then we also have some visualizations that we can create. And what's really cool about this spreadsheet is that it's basically like a blank slate that you can use to do all sorts of different math on. Okay, so first, now you have to have a Google account. So if you have a Gmail account, that's a Google account. So you go to drive.google.com, and then you go on the top left and see how it says New. You click on New, and then you click on Google Sheets, because Google Sheets is, like I said, Google's version of Excel. And then you click Blank Spreadsheet. Okay, so now we're 3 clicks in to this. Okay, then you're going to name your spreadsheet. Okay, so I call this thing, by default, it gives it no name. But I'm really big in organization. And so I call this thing Geeks 2019 Talk. And then you're going to click the first cell, A1. Now we're 4 clicks in, and you're going to type in, and this is a function that we're going to be using, which is very similar to what you would use if you're using an average, or you're trying to calculate a standard deviation, or you're trying to find the minimum or the maximum within a spreadsheet. It's just a function. So you say equals Google Finance, and then a parentheses, and then what you can do is you can see at the very bottom of that drop down, it says you can click on Learn More about Google Finance. Okay, so if you click that, you have a help guide that pops down and provides more information around that particular function. It provides, there's a lot of stuff that you can do with this. You can pull in the closing value, you can pull in the open, high, low, close, you can pull in market capitalization, you can pull in percentage changes. There's a lot of stuff that you can do with this freely available function. And so, so what we're going to type, and if you type this correctly, you're going to automatically pull in a whole list of data right there. You just say equals Google Finance. Now you have to give a symbol, which I'm saying in this case, SPY. Then I'm saying the close, right? So we have the option of saying open, high, low, close, or volume, comma. And everything, if you notice, is separated. Now this, by the way, is a good, if you want to take a phone out and do a screenshot, this would be the one to take a picture of, because there's a lot of information right here. Then you type in your starting price or your starting date, and then you have an ending date right here. Okay, and then you say, what do you want? Okay, well, what we want is we want daily data. We can use daily data, we can use weekly data, monthly data, yearly data. There's a lot of information here that we can get. And just like in programming, you have to separate everything by a comma, and you have to put everything in quotes, right? And a lot of this is case sensitive too. So try to be case sensitive to what I'm saying right here. Now a shortcut, now if you hit enter, you're going to get, and it's going to look exactly how it shows up on the spreadsheet. You're going to be pulling in 1 year's worth of data. So your start date of 2018, your ending date 2019 of July. Now you can also type in, and this is a shortcut, and this is very useful, so that every time you open the spreadsheet up, it's always going to get 1 year's worth of data. You can say eDate from today. This is a function within a function. You can say, give me 12 months worth of data to the current date. Okay? So what you have here, this is just a snapshot. So you just type this in instead, and it's always going to give you 1 year's worth of data. Okay? Okay, now what we need to do is we need to start calculating the percentage return, okay? And the reason why we do percentage returns is because financial engineering is all about making comparisons. It's comparing one stock with another stock, one stock with the futures, one stock with an index. And so if, let's say we wanted to compare SPY with TLT, which is S&P 500 against bonds. If we're trying to make that comparison, one is a $300 stock, another is a $130 stock. So if you have a $30 move and a $130 in if you have a $30 move and a $13 move, it's really the same. The percentage-wise, it's the same, but the dollar amount, it's about 2.5 times larger with that $30 move, right? So we need to standardize our data, and a lot of financial engineering is using statistics. And with statistics, we need to draw some conclusions about that particular data set. And so we turn our data into daily percentage change. Sometimes it's called log change. But what we do here is we say, let's start at C3. You say, give me the current price minus the previous day's price divided by the previous day's price. And so that's going to give you just a very simple percentage change, right? Be sure to put those parentheses there. And then the data should make sense, okay? So if you look at it day to day, so if you go from 271 to 270, what is that? That's a negative percentage change. So your data, your results on your percentage change should make sense. So always spot check it to make sure that you didn't get cross-eyed and move some number around. It should make sense. If you go from 100 to 110, that's a 10% change. If you go from 110 to 100, that's a negative 10% change. So make sure, just spot check it visually, make sure it makes sense. And one of the things I did here is I just, like you could do in Excel, you do the same thing within Google Sheets, is I highlighted the column and then I changed it to percentage movement. And then, so I just clicked percentage at the top and then I just color coded it just because I like things to look pretty. And so therefore it's making positive numbers green and negative numbers red, and there's different variations of the color palette, you know. And so then we need to get a little bit more information about this data set, right? Because we want to make comparisons with the S&P against other data sets, against other time series data. So I'm going to say it, start at F2, and I'm just going to highlight that daily change. And so I say equals average of the C column. And I also say, let's get standard deviation of that data. Now, standard deviation, it's very widely used within statistics, and sometimes it's misunderstood. But it's one of the most useful numbers, I think, that you can get within finance, within statistics. And there's a reason why it's so popular. It's because it gives us a more holistic information about, more knowledge about a stock than just looking at an average. An average by itself is this very one-dimensional number. It just says, okay, this is how much it's moved on average day to day. And that stock is moved day to day. If you look at it here, it's moved 0.03%, okay? And all that is just looking at the daily average of all these numbers. The standard deviation is 0.98. Which is about 1%. It just so happens it's about 1%. So that means that stock has moved up or down by about 1% a day. It just so happens that it's 1%. If you look at Tesla, if we did the same thing to Tesla, Tesla tends to move up or down every single day, multiple times the S&P 500 does. It's got a standard deviation of 3 or 4 or 5. And some stocks have even greater than that. Some stocks tend to move 10% within a day, some leveraged ETFs. Okay, so looking at this data, this is something that, all you guys women are tasty traders. So you've seen this thing so many times, but I'm gonna talk to you about it again. This is a bell-shaped curve. Okay, so if we plotted all of our distribution of our daily change, our data looks very similar to this. Okay, if you look at price and you try to plot price in a distribution, it doesn't look like a normal distribution at all. It can be very uniform. If the stock's going up, it can be very skewed. It can look choppy. Price does not follow normal distribution at all. But the daily percentage change, the weekly, the monthly percentage change, it does. For the most part, it follows a pretty normal distribution. Not perfect, but it pretty much follows this distribution right here, where you have the average is around 0%. Stocks tend to have a little bit positive skew to it, unless, of course, that stock's going, very much to the downside. But stocks, even when they're heading straight up, most of the stocks on average go up about 0% or a little bit positive of a percentage. The standard deviation is just how much it falls from that average, right? So if you get 0.03 plus 0.98, which is the standard deviation, it's going to be your upper range is expected to be 1.01. If you get 0.03 minus 0.98, it's about 0.95. So 68% of the time, one standard deviation, it's expected to fall between 0.95 on the downside and 1.01 to the upside. Now, if we double that number, if we double that standard deviation and just multiply it times 2, we get about an upside range of about 202 and a downside range of about -2, right? So it goes up about 2%, it goes down about 2% on average. I'm sorry, the expectation about 95% of the time is about that much. So 2 standard deviation move is about -2 to +2. 1 standard deviation, about 68% of the time, is expected to move up or down about 1%. Okay, so now this is something that we make this number into something that is more visible and something that we're more used to, which is the volatility component to it that we all are kind of used to. When I'm looking at standard deviation is very, very useful, but it's too granular, right? I don't really think of my portfolio as a day-to-day movement. I think of it as more of like an expectation of a year out or 6 months out. So what we can do is we can make this more recognizable, similar to volatility that you see, implied volatility. But what this is going to be called historical volatility. And so this is a calculation of historical volatility. You just start at F4 and you just multiply the standard deviation times the square root of 252. And this is kind of a further discussion for another day, but variance itself is proportional to time. When we get the square root of variance, and then it becomes time with the square root. So we multiply it to get an annualized number. We multiply it times the square root of 252 because that's how many trading days we have within a year. That's how many days we're looking at. And then we multiply it times that standard deviation. And then everything that we're looking at here is a percentage. So we change that number to a percentage. And that gives you the historical volatility. So what we're saying right here is that the standard deviation of returns for the S&P 500, the historical standard deviation, is about 15.5%. That's about how much it has moved in the past, plus or minus, right? And this is also what we can do, right? These are more visuals that we can create within our spreadsheet. And now, even though I love to program, I program every day through work, we program through Python, I'm always using spreadsheets. I use spreadsheets every single day as a way of prototyping ideas. There's nothing at all wrong with using spreadsheets. It's a great, great tool, and it allows us to kind of muck around with the data beforehand and test out ideas before we spend a lot of resources and make things more robust through programming. And you don't actually even need to know how to program for many things. A huge percentage of things can be just done all within a spreadsheet. So this is really a cool way of being able to build a framework, a template, by pulling in that data, and it allows you to be able to do a lot of statistics around that data set. So every single time that you open up the spreadsheet, it's going to automatically update with the most information, especially if you use that function that I showed you at the bottom with the eDate function within the function. It's automatically going to be pulling in all your data. And you can even make this spreadsheet even fancier, and if you do, share it with me. Show it to me, and I'll maybe put it in a Cherry Picks, the free quantitative newsletter for traders that we release every Tuesday. I'll put you a little shout out at the bottom because other people would find it useful too. And then what you can see here on the bottom right is it's a histogram of daily price change, right? So that's very much of that normal distribution. There's a lot of stuff centered around zero because that's the zero movement that we tend to see day by day, but then you can see a little bit of skew of the data. So this is a picture I like talking about, and I like showing when we're talking about risk. This is a couple, they're throwing their little precious cargo across a ravine. And this is a total photoshopped picture, but it's they're actually throwing a backpack, but somebody changed it to a little baby. But it's I wouldn't do this to my own kids. I love my kids, but sometimes I'm tempted. But they're obviously taking a lot of risk. You don't have to take a lot of risk. We're all comfortable. There's not one risk that's really appropriate for everyone. And you always got to take what you're looking at with no statistical number is going to be perfect. No model is going to be perfect at all times. You know, every model, every statistics has some level of error within it. You just have to be aware of that level of error. Prices don't always follow a perfect normal distribution. There's always some degree of error in everything. But one of the things that I try to really preach is to just be aware of your data set and the information, to try to get as much knowledge as possible from it so you can become just a better, more informed trader. The largest maximum drawdown is one level of risk, and that just shows you how much the stock has moved from the peak to subsequent low. You can do this calculation within the spreadsheet. It's pretty easy to do. Value at risk, sometimes it's called VAR. This is used a lot within the brokerage industry of being able to assess the level of risk within an individual position or within a individual equity. Because what it is it's looking at that change or that stock drawdown or that movement that's expected about 5% of the time. So some stocks, like Tesla, for example, has a much greater VAR because the movement is going to be much more severe. You can Google this online and you can find out the formula for that. That's a very, very popular measure. Correlation, that's just the relationship between two different symbols. And correlation is used directly, and you can do this correlation measure between two different symbols, between two different price daily changes. It's a piece of cake to do this, and you can do this yourself. And beta is directly related to the correlation. And we've done some skinning on options data science, looking at beta and understanding and a more holistic understanding of beta and its relationship with correlation. So in conclusion here, we looked at one way of pulling in data and creating a template with it, understanding some different levels of risk and reward, and then this very important concept that financial models shouldn't replace common sense. Is the stock, is it appropriate for you? And the more information that we can gain, the more knowledge that we can gain about a particular position, the more we can become aware of the potential for maybe disaster of a particular stock. And then we can do a better job as far as protecting ourselves against it. We can sell calls against our long positions. We can sell puts against short positions. We can use short puts in place of stock. There's all sorts of different strategies that we can do to protect ourselves, and it helps us become a more informed trader. So, by the power invested in me in Taste Trade Nation, I'm going to make you an honorary quant in training for fulfilling the obligations of this 30-minute lecture. Thanks.